Hi there. Today I want to talk to you about assumable loans, specifically assumable mortgages. Do you have an assumable mortgage? Do you know what an assumable mortgage is? Well, to assume someone's loan means to take it over, to step into their place and be the one responsible for making those payments. And many mortgages today are assumable. That means that you can do just that. You can take over the person's loan and you can buy their house in doing that. Now, why would you want to? Well, we're in a higher interest rate environment now. There are people out there with 2 and 3 and 4% mortgage loans. And if you wanted to buy the home of someone who had a loan like that, wow, wouldn't that be nice to have that nice low interest rate? And oftentimes there's a way you can do that. You can take over that person's loan. Now, one of the more challenging parts of that is coming up with the cash to do so. So what I'm getting at is if you're buying a house, let's say for $300,000, and the person has a loan on it for $200,000 at 3% or whatever attractive interest rate they might have, you come up with the difference in cash to take over their loan. So if they owe $200,000, you're paying them $300,000 for it, you have to have $100,000 to give that seller and then take over their $200,000 mortgage at 3% or whatever that low rate is. And wow, that's a good thing to do. But the challenge, as you can see, is coming up with the cash. Now, there's different ways around that. You might come up with the money, you might have it, and it might work out perfectly. Maybe you borrow that money from a family member. Maybe you reach an agreement with the seller that you owe them that $100,000, and there is what we call seller carryback financing, where you're paying their loan on that $200,000, but you're also paying them a little extra because you have borrowed money, maybe that whole $100,000, to assume their loan. You're paying that directly to the seller. Maybe you've, again, borrowed the money from somewhere else. But that's an important component of being able to assume someone's loan. Now, if you're able to do that today, just know this, that you will have to do it while qualifying to do so. In other words, you will approach that mortgage company, you and the seller together, the mortgage company that has the existing loan, and say, I want to assume this loan. And oftentimes they will allow that if you qualify. So you'll go through the same process as if you were getting your own loan, typically, to make sure that you qualify to take over that loan. And in qualifying for it, the previous homeowner is relieved of their responsibilities in connection with that loan, and then the responsibility is yours. In the 1980s, there were loans, FHA and I believe VA, that were assumable without qualifying. In other words, you come up with the cash, you take over the loan, no questions asked. You don't have to qualify to get that loan. And a lot of houses were sold that way, and it was kind of exciting from what I understand. I wasn't doing it in the 80s, but in the 90s, a lot of those loans that were originated in the 80s were non-qualifying, assumable. And I'd like to play that game again, but it's not out there. But just know this, if you want to buy a house with a low interest rate loan on it, maybe you can assume it. Hey, and if you're a seller and you know you've got this attractive low interest rate loan and you want to sell your house, that could be a good marketing tool, letting people know, hey, I've got this 3% mortgage, and if you qualify, you can assume it. You might attract even more buyers that way in this current seller's market. Have a great week.